Matthew Bell with InsurancePrescription.com, and today I just wanted to talk through some of the changes that have been implemented in terms of contribution limits for the upcoming year 2020. So as I record this in November of 2019, the fourth quarter of 2019 is coming to a close, and it's no surprise that now there are modifications to some of the contribution limits looking forward to the year 2020. So for this, I am relying on the IRS, recent IRS publication, as well as an article in Forbes titled "Great News from the IRS for Retirement Savers." And that was from the author David Ray, published on November the 20th of 2019. Now, whether it's great news or not, I'll briefly mention. I kind of get into it in other videos. It's really dependent on your situation, whether or not, and your projection about what you think is going to happen in the future as to whether or not you think this is a super great thing, or maybe it's just so-so. But let's get into it. I'm going to address employer-sponsored plans, traditional IRAs, Roth IRAs, and simple IRAs in this video. So what I'll do is I'll put on the screen all of the recent changes so that you don't have to watch the complete video if you just want to get a fix on how things are standing presently. And I'll just kind of run through the changes and then I'll put them in the context of the last 4 years. But 2020 for employer-sponsored plans, and here we're talking about 401k, many 403b and 457 plans, as well as the thrift savings plans or TSP, and sometimes profit sharing follows a similar trajectory. But the employer's contribution level, if you are younger than 50, is $19,500 going forward in the year 2020. The catch-up provision will be raised to $6,500, that is if you're over 50, and the total amount that can be put into the 401k and other employer-sponsored plans is going to be $57,000. That's including the employee match. So, but if you are younger than 50, your amount is $19,500. If you are older than 50, then again, it's going to be raised up to $26,000 because you'll be able to put in an additional $6,500. For traditional IRAs and Roth IRAs, in the year 2020, the contribution limit, if you are younger than 50, remains at $6,000. The catch-up provision, if you are older than 50, is $1,000, bringing you to a total of $7,000 that can be placed in traditional IRA or in a Roth IRA. And the simple IRA in 2020, $13,500. With a catch-up provision of $3,000. So I think it would be helpful to at least map the terrain over the last 4 years. So that would be 2017, 2018, this year 2019, and then the upcoming year 2020, 4 years. And I will kind of post visuals, I hope, that will elucidate a little bit what I am saying here. But when we talk about employer-sponsored plans, there's a couple of different definitions of employer-sponsored plan. And by the way, I have videos where I concentrate just on the 401k, on the 403b, on the 457b. I've got videos on each of those separately, so if you want to really get into the details of those, I invite you to please click on those. I'll put links in the description. But starting in 2017 for the 401k, and let me just say one word about employer-sponsored plans. So one definition of employer-sponsored plans would just be those plans that you have access to through your place of employment, through your job. Another definition hinges on whether or not the plan is actually governed by the Employee Retirement Income Security Act, or ERISA. And I'm not really going to get into the weeds on that particular issue, so I'm just going to have an intuitive definition presently in terms of employer-sponsored plans are those plans, those retirement vehicles that you have access to through your employer. And they're exactly what I just said, the 403b, the 457b, and the granddaddy of them all is the 401k. So in 2017, the contribution limit under 50, now there's really going to be a cutoff here between being younger than 50 and being 50 or older. If you're 50 or older, the IRS applies what's called a catch-up provision. Now, just a word on the catch-up provision. It is not something that employers have to take on board. Employers do not have to allow the catch-up provision. However, many do. The IRS provides for it, but employer plans may differ, so you really need to contact your plan administrator or your human resource advisor for details on your specific situation. But for the present purposes of this video, I'm just going to kind of go into some generalities here. So in 2017, The actual limit, if you were younger than 50, was $18,000. That was in 2017. The catch-up provision was $6,000, bringing you to a total of $24,000 that you could actually contribute to your 401k. In addition to the amount that you can contribute to your 401k, the IRS actually also stipulates a total maximum that can be put into the 401k, and in that year, in 2017, it was $54,000. That means that the total amount that you put in plus your employer in 2017 could not exceed $54,000. In 2018, that rose to $18,500. The catch-up provision remained the same at $6,000, and the total contribution in 2018 was actually $55,000. This year, the main contribution level increased to $19,000. So it was $18,500 in 2018, and in 2019 it was actually $19,000. The catch-up provision remained the same at $6,000, and the total amount that could be contributed into a 401k in the year 2019 is $56,000. In 2020, your contribution is going to be limited to $19,500 if you're less than 50. If you have the catch-up provision, if you're 50 years old or older, you'll be able to put in an extra $6,500, bringing you to $26,000 total. And including employer contributions, the maximum amount in 2020 that will be able to be put into a 401k is $57,000. Now, in fact, the contribution limits to traditional IRAs and Roth IRAs has not changed from 2019. But let's review them from 2017 on. So from 2017, the contribution limit for under 50 was $5,500. The catch-up provision was $1,000, bringing you to $6,500. In 2018, again, it was $5,500 with a catch-up provision of $1,000, bringing you to $6,500. In 2019, your main contribution level is $6,000 with a $1,000 catch-up provision, gives you a total of $7,000 that you can put in. In 2020, you will be able to contribute $6,000 and have a catch-up provision of $1,000 if you are 50 years old or older. That's the traditional IRA. The Roth IRA in 2017, again, was $5,500. This is going to be the exact same thing as the traditional IRA, by the way. Catch-up provision of $1,000. In 2018, $5,500 with a $1,000 catch-up provision. And this year, 2019, the contribution limit was raised to $6,000. And the contribution limit for people who are older than 50 includes a catch-up provision of $1,000, bringing it to $7,000. And in 2020, that is supposed to stay the same. So in 2020, you can contribute $6,000 to your IRA if you are younger than 50 years old. If you are 50 years old or older, you can contribute another $1,000, which brings you to $7,000 for your total contribution. Now, the simple IRA is a little bit different. In 2017, the limit was actually $12,500, and the catch-up provision was $3,000, and that was exactly the same in 2018. In 2019, that contribution limit was raised to $13,000, and the catch-up provision remained at $3,000. And for 2020, your main contribution has been raised slightly to $13,500, but the catch-up provision apparently remains the same at $3,000, which would bring you to $16,500 in 2020. Okay, so just quick review. Obviously, we've gone through a number of different vehicles here, but traditional IRA, Roth IRA remain the same, $6,000 contribution level, 50 or younger, $1,000 catch-up provision bringing you to $7,000 total if you are over the age of 50. For your 401k or other employer-sponsored plan, $19,500, $6,500 catch-up provision bringing you to $26,000, and the total, including the employer match, can be $57,000, but no more than that in the year 2020 coming up. And for simple IRAs, which are a little bit less common, it's $13,500 for the main contribution, $3,000 catch-up provision bringing you to $16,500. Let me just say a word about the question of whether or not this is a good idea for you to take advantage of this full contribution or not. Clearly, having the option is good. So the fact that the contribution limits are being raised is a good thing. It is predictable since cost of living increases essentially are going to demand and dictate that these contribution limits are going to have to be periodically raised, and that's the point of them, is to kind of keep pace with the expectation of how much you're going to need in income in terms of retirement. This could get really bogged down, and of course we don't know exactly what's going to happen, but the advice would be to try and put as much away into retirement programs as you possibly can. Now, when you're thinking about traditional IRAs, 401ks, and the like of that, where the contributions are put in there on a pre-tax basis, so you get a tax deduction on your contribution, then the contribution grows tax deferred, and you only pay tax when you take it out. In favor of them, the argument is twofold. Number one reason would be, if you are not taxed on your earnings, then that leaves more in the vehicle to compound, so your money can kind of snowball a little bit faster than it would otherwise. The second consideration and reason would be that, generally speaking, when you think about your retirement, while you're in your working years, you'll be in this tax bracket, and when you retire, you're going to take a pay cut and you'll be in a lower tax bracket. Does it always happen that way? No. But does it often happen that way? Yes. And so the idea is, while you're in your earning years, if you could squirrel away money and not pay tax on it until you have dropped in tax bracket, then you pay tax on it, you're going to save in terms of your tax liability. Now that's true. I get into this in other videos in more detail. The joker in the deck there, however, is the fact that the tax rates that are assigned to each of these tax brackets are not fixed for all time. So there are scenarios under which you can envision being in a lower bracket but paying as much or higher tax as you would have paid in this bracket in your working years, and one reason that might occur is if tax rates are uniformly raised. So one argument for putting money into an alternative vehicle besides the 401k and the traditional IRA would be, try to settle your tax up now. You're taking a deduction in the 401k and the traditional IRA, but if you are paying post-tax dollars, let's say into a Roth IRA or even into some sort of life insurance retirement program, then you can settle the taxes up while we know what the tax rates are. That way, if taxes increase in the future, you will not have to worry as much. The idea would be, especially with the Roth, the way it functions is you would pay tax on the contribution, it would grow tax deferred, and then you would get the earnings tax-free as long as the account has been open for 5 years and you are over the age of 59 and a half. Now there are a lot more considerations, many more than I can get into in this video. It was just supposed to be a short video, sort of running through the changes in some of the contribution limits. I'm going to leave some of these conversation threads open. If you are interested in picking up any of these loose ends, I invite you to click on some of the links that I'll have down in the description. I have other videos where I do get into this information a little bit more. I should say, finally, as a disclaimer, I am not a financial advisor. I cannot give you financial advice. I am not a tax preparer. This video is not intended to provide you with specific advice of any kind regarding finances, insurance, investments, taxes, savings, retirement, nothing. It is simply designed for general informational or entertainment purposes. If you need special advice, recommendations, consult a licensed professional in your area. But I do thank you for being with me today. If you found something of use in the video, please like it, please subscribe to the channel, click the notification bell to be alerted to new content as it becomes available, and I look forward to seeing you again in another video. Thank you.